Welcome to the Aquest Podcast, conversations about regs, funds, and governance with your host, Daniel Lawler.
Hello, podcast listeners, and welcome to the Aquest Podcast. It's heatwave time in Ireland in that it's more than 20 degrees, and certainly the good weather is helping us to survive COVID lockdown, and in particular, the stresses and strains of homeschooling three kids that don't really want to be homeschooled. For this episode, we wanted to take a little look beyond the Irish island and look at how Europe more broadly was facing and seeing itself through COVID-19 in terms of the asset management industry. Who better to do that than have Federico Cupelli, who is a senior regulatory policy advisor at EFAMA, the European Fund and Asset Management Association, join us to explain what he sees from his kind of unique perspective, having members all across the European Union feed in with information and data and analysis of market developments, and also being the European Association, they're very centrally involved in the European regulatory agenda from the industry perspective in terms of preparing responses to consultations. So he's right at the heart of both market and regulatory developments, and a great guy to have to explain to us how all of that is playing out in our COVID-19 world. As always, I'm joined with my co-host, Shannon Eastman. Check her out at shannoneastman.com to see all of the strings to her bow. Delighted to have Shannon along, of course. So settle back, relax, enjoy, and find out what's going on at European level during the COVID-19 crisis. Federico and Shannon, welcome to the Aquest Podcast. Great to have you guys here.
Good afternoon, Daniel. Great to be here. Thank you for this opportunity. And thank you to Shannon for helping us put this together.
And I'm happy to be back again. I'm looking forward to this conversation. I think there's some really interesting points that Federico raised, and I'm looking forward to seeing how this plans out.
You're getting to be an dab hand at the podcast co-hosting, Shannon.
I'm working on it, Danny. I'm working on it.
And you've got your ETF lingo down.
Exchange traded funds. I'm looking. Yeah, that's part of today's conversation. I'm ready.
And what about lockdown life? You loving it?
I'm now referring to it as rollout. I'm done with lockdown. This is all about rolling out now. So yes, Danny, I'm thoroughly enjoying the creativity. I'm thoroughly enjoying all the different perspectives that we're getting. I appreciate that we're in Ireland, so we get it. It's a little bit easier for us here than in other countries. What's it like over in Brussels, Federico?
It's sunny, which is probably the only thing that matters. It's better than it was a few weeks ago, but I think that we're slowly beginning to emerge from this, and I'm happily also back in the office where I tend to be more productive as I don't have a 4-year-old son interrupting all the time.
I know what that's like. I think for me, I don't think COVID's going to kill me, but I think homeschooling might kill me. Or somebody's going to, if it's not me, it's one of the kids. Because I find I spend most of my time I have 3 of them, herding them to sit down and do what it is that they're supposed to be. And as soon as you take your eyes off one of them, they're gone. And you got to go, and you just spend the whole time chasing around. So let them back to school.
Are they going back this year, Danny?
Well, they're talking about going back in September, but now they're talking about blended return, which means some of the time in the school and some of the time homeschooling. And I heard that this morning. So my mood has been grim as a result.
Are the kids back in school over in Brussels, Federico?
No, not yet.
Is that happening this year or September or what?
It probably will. They'll reassess in the course of the summer, and if all goes as things are, they'll be allowed back in September.
Wow.
Now, Federico, we've known each other for quite a while, since you were in the French regulator and I was in the Irish regulator. And now that we're both out, and notwithstanding our confidentiality obligations, I've always wondered how the AMF got such good people, because I was always very impressed. I dealt with them a lot at ESMA and IOSCO, always very well briefed, very, very good English, really on top of their briefs and on top of their game. How did the AMF do it?
Connections would be the short answer. I happen to be working with one of their detached national experts while at the commission. So I guess she liked the way I worked. And as soon as she returned to Paris, after her stint with the commission was over, she gave me a ring and said, I have a vacancy. Would you be interested? Certainly. Did the interview. And I think it only took them 3 weeks to go through all the interviews and and propose a contract. So I was very quick. I was also very surprised because, as everyone knows, French institutions still tend to be very French. I was a bit the visitor or a bit of an outlier. But it was an extremely valuable experience in one of Europe's, I think, best regulators. They certainly punch way above their weight.
They do, and they have a wonderful habit of getting their own way.
Yeah.
How do they do that, Federico?
How do they do? I haven't quite figured that one out yet, but they're a very close-knit community. Them, industry, and the other financial institutions that are, French-based. So they're very well organized, I have to say. Less so the authorities in my country.
Well, certainly very impressive in France. And of course, now you're kind of the other side of the fence now, Federico. You're with EFAMA.
Yes.
You kind of in a policy role there as well?
Yes, not too different from what I was doing at the AMF, but I've, as you said, changed sides. So the good thing is that I occasionally still have a chance to lobby my former colleagues. And the fact that I've been with a national supervisor lends me a bit more credibility, I think. Also in how I read the regulatory landscape and things to come. Apart, of course, from all the contact base that I have, kept and occasionally really rely on.
And how do you approach then lobbying, Federico, having been the other side of the fence? Because I remember well, as a regulator, obviously whenever you engage with somebody from industry, it is on your mind that your counterpart has a vested interest in some shape or form. So you always know you're being lobbied. And sometimes the engagement is fruitful and the other side will tell you things you didn't know, give you intelligence, give you very good impact assessment, but fair and not, not completely biased. And other times it can feel like your counterpart is telling you all the things that's wrong in the world with no offer of solutions, and it feels a bit like a whinge. So how do you kind of get that balance right now that you're kind of on the lobbying side?
Well, I like to mention that I was a former regulator, so I think that this already does away with at least some of the skepticism that some regulators still share when they look at industry representatives. I think that as we move further away from the global financial crisis of 2008, the level of the conversation has become a bit more sincere, but it very much also depends on who you're talking to. The regulatory community is broad, and I tend to do better with those regulators that are really interested in facts-based evidence and really want to know what the industry perspective is. There are other corners of the regulatory community that unfortunately have a political agenda. And so you can be as exhaustive and as detailed as you like, but if you are not in line, let's say, with the political objectives of that institution, then you being there, talking to them and engaging actively won't bring too much.
No, it can certainly be a very political process, but the engagement between industry and the regulator can be a very valuable process from the regulator's side, because they're, to an extent, as a regulator, certainly as a policy side, you are working a little bit in a vacuum when you decide or you're coming up with new regulatory proposals, and how you calibrate them and how you decide how far to go with the rules depends a lot on impact. And sometimes you don't have great information impact. You really do depend on industry to give you that flavor for, well, if we draw the line here, this is the cost. But if we were to do it here, we achieve nearly all we wanted to achieve, but the cost is a lot less. So it can be a very valuable engagement from a regulator's perspective if it's done well. But in the current COVID-19 world where you're working from home, I know you're back to the office now, but that kind of, I guess before you would have done a lot of personal engagement to help you to meet your counterparts and regulators and exert influence in and convey information. Is that tougher now that you're probably doing that all virtually?
Definitely is. It's definitely become more difficult, and we, at least from my experience, we have basically had since the start of the COVID, our regular meetings and exchanges reduced by 2/3, I would say, roughly.
Wow.
Most of it is now done via call, not even by a conference call, but really by call, and only if and when necessary.
And how do you find that then in EFAMA engaging with your members? Is it similarly a very different world there?
It's very different, yes. I mean, we're still obliged to use the telephone and the video conference but there the exchange is as regular, if not more regular than before, given that there's already a lot of work, even more than before. So this obviously justifies a continuous exchange and discussion with the members.
The topic of the new normal is something we've come across a lot in the last few episodes of the podcast, whether it's, ways of working and on the HR side of things. From your perspective, do you think this is kind of the new normal for you and for industry associations, that it's more engagement at a distance and virtual engagement, and it's going to be that bit harder to get that direct engagement with your end stakeholders, your regulators and what have you?
Yes. I mean, it's not optimal, but I wouldn't say it's the new normal. I would say it's more a matter of short term, at worst, medium term. But I am rather confident that we'll be going back to engage as usual. It may be early next year, but I really do hope that we will be able to get back to have that qualitative engagement that we had in the past. Because as you were saying before, body language also matters, and so that is already a good chunk of the communication that goes on in a room. The fact that you're not there to see that person makes things rather different.
Has there been an opportunity during this COVID-19 experience to reevaluate your priorities and reevaluate what's important and what needs to be shelved?
Absolutely.
How has that changed from the priorities going into COVID to the priorities that you're working with right now? Aside from business continuity, I think business continuity is across the table, but have you, I'm kind of looking at the 50-foot view, taking a step back and going, here's all the stuff we were focused on for the last 12 months. Mm-hmm. Is it really important? Has that happened? Have you guys had a chance to review?
Absolutely.
Really matter?
Absolutely. I mean, it's been fundamental to our own well-being and survival. We each one of us here at EFAMA has a number of priorities that he or she needs to carry out and implement within roughly 3 or 4 different standing committees and task forces. Some of those priorities have been shelved for the time being. If work is not tied to an impending consultation or anything urgent of that kind, or related to giving the regulatory community the information it seeks in this precise moment, then the rest has really taken a back seat. So to give you an example, a lot of work has had to go into communication with our members, first and foremost, where we've consulted them to try and gather intelligence, both at a company level and also to know what is happening domestically in their own interactions with their supervisors. We have had to also, based on this information, prepare a whole suite of communications and letters to the EU policymakers to inform them on market developments, especially in terms of what was happening in funds, in terms of investor flows. It was also important to reach out and obtain postponement of reporting and compliance deadlines as required by the legislation in force, as well as of public consultation deadlines. We also did articulate, especially to ESMA, that it should exercise leniency and greater forbearance in those instances where firms were not able to meet their regulatory requirements. In this regard, we sent a letter to ESMA in late March. And then we have also been engaging with other actors like the ECB, for instance, where we made a number of recommendations related to its pandemic emergency purchase program more recently in relation to money markets.
Wow, it sounds like there's a lot of regulatory implications that had to be, one, annotated, articulated, and then two, actioned.
Exactly.
More than just two or three. What were the regulatory implications that you guys threw up on the whiteboard and then said, right, this is how we're going to action it?
So there were a number of deadlines, for instance, concerning reporting requirements for NMFs to report on their stress tests. There was a postponement that was needed in terms of giving us more time to answer a very complicated consultation, the one tied to MiFID II MiFIR. Mm-hmm. We've been successful in this, so this was positive. Moreover, it was also a lot of work going into communicating with the broader public by revamping our website, dedicating a section of it to COVID-19 related developments, summarizing all of our key actions, and really offering continuous updates on what we were producing day by day. So copies of all of our letters and communications with the policymakers, as well as with other industry bodies. And also our figures, which is something that EFAMA does. So we, of course, look at policy, we make recommendations based on what our members believe is right for our industry, but we are also, we have a research team here that gathers information across all of our member jurisdictions and puts out industry figures as well. So it's really, it's these two things, presenting them in a public manner on our website and communicating them to the broader public, that has also taken quite a bit of our time.
I'm really interested in the market developments that you saw as a result of COVID-19. But before we go there, on the regulatory side, the regulatory agenda was pretty jam-packed before COVID kind of kicked in. And it felt like we were going through that part of the regulatory cycle that was far enough away from the previous financial crisis that it was kind of assessing how well the legislation introduced on the back of that crisis was working, how well were the various pieces of legislation sitting together. And as you said, Federico, that's a little bit being pushed back a little bit because of the COVID-19 crisis. Do you think that pace of that is going to pick back up and we're going to get back on track? And that's going to still be the kind of the focus, this smoothing out of any wrinkles between the piece of legislation?
Yes. I mean, that is ongoing work, and I don't think that the COVID has changed that in any way. My guess is that COVID has actually added to the existing initiatives, either for these to be tweaked, changed, amended, or there is simply more work on top of the pre-existing files. So we are really struggling, which is why working remotely has been very difficult. So we're a team of 15 here. Each of us has had to deal with a number of files. And also another challenging aspect has been, getting members' feedback. They are working from home as well. Some businesses have been disrupted. And so it was often difficult to get high quality inputs to then feed into our work. As we slowly come out of this, I think that in those instances where we've been offered more time, we'll definitely, try to rectify the to let's say not rectify, but to at least complement with more insights. Yeah, go ahead.
I was going to say, I guess if you think back, Federico, to our lives as regulators, I went in sort of post-crisis, or actually we weren't quite the other side of the crisis, but a lot of the legislation that came out at that time was designed to either prevent the next crisis or make firms and the markets generally more resilient if or when that crisis arrived. And I guess that's where we are now. It's kind of the testing ground for the reforms introduced around 2010, 2011, 2013. And so when you look at the market developments, do you think that the reforms have had an impact and had the desired impact? They've made firms and markets more resilient than they might have otherwise been, that the impacts have been kind of manageable, albeit that they've been there, of course.
So from what we're seeing, they certainly have. And I think that the asset management industry has passed this test extremely well. A lot was put in place, as you said, post global financial crisis. And I think it's being tested through a crisis that is even more severe. So I think that overall, if we look at the fund management space, we're passing this test, and this is really also enabling us to get better figures around what is happening, to really demonstrate how effective and good some of these reforms have been. Take money market funds, for instance. We've seen severe market stresses in March. This prompted us to reach out to the ECB, suggesting some minor changes to its PEP program. And despite the fact that we have not yet obtained these, markets have continued to work well, although still stressed. We've been seeing inflows in MMFs, for instance. So nothing like the kind of experience that we saw in late 2008 and early 2009. We actually did see that in April, money market fund inflows picked up considerably, flowing back in. So you have investors really across the board, be they public bodies, corporates, or even high net worth individuals. We're seeing something that is really completely different from what we saw.
Yeah, I guess if you believe in markets and you believe in money talks, then seeing inflows into money market funds is validation that the market believes that the structure and the infrastructure and the tools that they have are sufficient to get them through this, and that it's a safe place to invest your money. Indeed.
And you can also think about the liquidity management tools that we have in place, especially for those funds that are structured as UCITS in Europe. I think this crisis shows that how resilient the UCITS regulation is, and everything around it, because it's not only UCITS, but on the side you have you have MiFID, you have EMIR, you have SFTR, not to mention, of course, all the ESMA Level 3 guidelines, Q&As and the like. So I think that over the course of the decade, the amount of regulation that has been put around our activities has, in the end, really helped us. And it's quite surprising to still nowadays, despite the fact that we've passed this crisis with flying colors, hear from some in the regulatory community that more needs to be done. And again, they're referring here to us as shadow banks, which is something that we thought we had left behind for good after a decade of implementing these measures and really proving how we are not systemic as some believe in the central banking community.
Yeah, I was going to ask you about that, Federico, because when you said the asset managers and the asset management industry had proved itself, I just wondered whether that was the view that the sense that you had, that was the view that regulators shared as well. But regulators and industry had kind of moved away from that term shadow banking in relation to, say, asset management, and they talk about non-bank financial intermediation, which is, I think, a more accurate description. But the fact that it's re-emerging, I guess, shows that there are still regulators who have concerns and who probably want to go again at whether funds are systemically important and what kind of controls need to be put in place. Is that back on the agenda now? Yes,
unfortunately it is. It is important to distinguish the different sides of the regulatory community. I would say there are two big camps. On the one hand, you have the national market supervisors, like the Central Bank of Ireland, the AMF, etc. Those are people that monitor the markets on a daily basis, and they understand what non-bank activities are, including fund management, among others. Then you still have parts of the central banking community, the people that usually gather at the FSB level. But now increasingly in Europe, it's the European Central Bank and the European Systemic Risk Board that are rehashing a lot of the hypothetical concerns that were once proper of the FSB 10 years ago. You may remember the work around this.
I do remember. Will I ever forget?
How can you? Around this methodology to designate GSIFIs, global systemically important financial institutions. And so asset managers were supposed to be designated just as well as banks and insurers, but on the basis of a methodology that was designed for banks. In Europe, we're seeing the ESRB, the European Systemic Risk Board, especially come late to the party and say there are systemic risks or potentially systemic risks in funds. Not only that, but they have a power to issue recommendations that are now going straight to the European Commission, and that the European Commission will have to look at as it goes about reviewing the AFMD, for instance. It has also issued a number of recommendations directly at ESMA, encouraging ESMA to do an in-depth study on financial stability implications of funds exposed to corporate debt and real estate assets, as well as telling ESMA to consider guidelines to come up with a consistent methodology to measure leverage in alternative investment funds, to the extent that leverage is believed to contribute to systemic risks. And then there's also a lot that the SRB would like to do in terms of implementing and operationalizing some of those recommendations, or actually provisions, that you have under Article 25 of the AFMD. So these are those, let's say, macro-prudential tools that would allow the supervisors to impose leverage limits on any one fund, or to directly suspend them in the name of public interest. And these, in our view, are a bit extreme, but it simply tells you that there is an institution there that has not understood how we essentially operate, what the difference is between an open-ended fund and a bank. and has a very strong political agenda that is now being encouraged by the fact that we're going through what we're going through. But the flip side of that is that this crisis has really offered us renewed firepower to argue back on the basis of evidence and not on a series of hypothetical assumptions that, if you read their papers, are really out of a game theory book.
And Federico, where you've seen asset managers and funds hit issues and stresses during this crisis, what kind of areas have they been in, and do they support concerns that central banks have or about siffiness of funds, or do they kind of prove that actually the reforms in place already around things like liquidity management have done what they were supposed to do?
Yes, certainly. So they prove that the regulation in place has done what it was supposed to do. But secondly, it simply casts a very important light on investor behavior. So regardless of the legislation in force, we are seeing, looking at inflows and outflows, that there have been no instances of one-way markets, fire sales, liquidity spirals. These are the terms that you usually find in a lot of the central banks' analysis, where they draw these end of the world scenarios where everything goes down, and then basically it's up to the public purse to bail everyone out. Looking at flows across fixed income, equity, money market funds, we clearly see that the outflows, for instance, experienced in March, were only a tiny fraction, and here I'm talking about 3 to 4% of total assets invested in those structures in Europe. So it is really a tiny part, a drop in the ocean, almost, if we look at what flowed out of funds and then what came back in March, because following the monetary easing and the further stimulus packages, we saw a significant rebound. And so, whereas in March you had net outflows, April saw net inflows. If the ECB's theories were right, we would have had a catastrophic loss of value even across the following months. No investor would have dipped their toes into any fund, even if securities, funds, stocks, bonds presented valuable buying opportunities. So I think that they do not fundamentally understand the market, and there is really some education that needs to be done in these, as I said, corners of the regulatory community.
Well, that could be I don't know if blessing is the right word, but that could be a positive from this experience, that the markets have put the products through pretty severe stresses and testing, and products that come through that well can then demonstrate in a real life scenario that they've done what they were supposed to do. And we're big fans of ETFs on this podcast. Isn't that right, Shannon?
Yes, we're not as much as Federico, though.
Well, we had Ryan Sullivan from BBH on a couple of episodes ago, and we had a really good chat with him about ETFs, and particularly, I guess, how they performed in the States. From a European perspective, Federico, how have ETFs performed? Have market makers continued to make markets and prices continued to be made, and what have you? Anything that has arisen during the crisis that's kind of surprised you, or are you pleased looking at the product with how the structure of it has held up?
No, I'm very pleased, and I think that ETFs have really performed as they were intended to, as they've been structured to perform. And I think especially ETFs are the most salient case to really show how resilient these products have been. Again, the ECB and the ESRB are concerned about ETFs as well. They see substantial growth coming from these products and have last year come out again with a number of papers saying, well, these may be systemic as well. Really not understanding what the mechanics of the ETF are in terms of difference between primary and secondary market, and the additional layer of the liquidity that the secondary market gives you, especially around times like these where you have sudden market corrections. So overall, I would say that ETFs have really proven, to be resilient. By the way, they are also in Europe tightly bound to the UCITS wrapper, because that is how they are structured. And secondly, they have also acted as a price signaling mechanism, showing the broader market where the underlying prices are trading, even when the components of their underlying baskets could not be as easily traded because of liquidity concerns. Those discounts that you have seen, so those were expected. That is what happens when markets reprice. However, they were only temporary. And this again goes to show that these temporary dislocations really do not bring about those long-standing economic damages that some are fretting about.
That's something we chatted with Ryan about, and he kind of explained in the American experience where the exchange and the primary market prices tended to diverge. What you tended to see was that actually it was the primary market price that tended to catch up to the secondary market price, that the secondary market actually, if you like, priced things properly, and that it just took a little while because if you were dealing with underlyings that were bonds or whatever, and there wasn't tons of liquidity in the market, it took a little while maybe for them to catch up, but actually that price discovery mechanism worked quite well.
Exactly. With no authorized participant deciding to withdraw because it could not hedge its exposure properly. Actually, quite the contrary.
What do you think is the regulatory landscape then for ETFs? Do you think there's more on the way? I know it's obviously it's on IOSCO's radar. The Central Bank of Ireland had done their discussion paper, and they kind of had left open whether they might look at a few elements around it. Do you think that we're going to see a rush to do more in terms of regulation of ETFs?
No, I think IOSCO will certainly be dictating the pace of that. So they are intended to consult, I think, later this year or early next, and then we'll see to what extent they believe the existing principles are to be amended. I guess they will, because they would need to make some space and give the broader ecosystem some recommendations as well. So far, as you know, the 2013 principles do not look at APs at all, or the other liquidity providers. And so I think that this is going to be an occasion where they are going to beef the existing principles up with some regulations that address the broader ETF ecosystem. Then, following IOSCO's work, or whatever the outcome, we're likely to see something happen in Europe as well. I know that have been some rumors around ESMA reviewing its 2012 guidelines on ETFs and other UCITS issues, and things of this kind.
I don't know. I think, Shannon, that's quite a lot of technical chat. What do you think?
I was quite happy to learn and listen and take notes.
In terms of...
I enjoyed it, but I learned more than I could contribute.
Well, I did want to ask a little bit about ESG, Federico, but is that, so ESG, environmental, social, governance, like a huge piece of the regulatory agenda, but also increasingly driven from the investor side and investor demand. And I can't really see that going anywhere other than up. Is that your experience as well? Is that your expectation that we're going to be living in this world? Absolutely. And the taxonomy will be kind of settled, and
I'd actually add to that, Danny. I'd say if you look at the crisis we had 10 years ago, and then you look at the situation that we're in now with COVID-19, we have tested, refined, upgraded who we are and what we do, so that we could rise to the challenge of this current COVID-19 situation. we're going to improve all of our resources and what we do and who we are today so that we can meet the next big COVID-19. So if you were to consider the evolutionary growth curve, it can only go up. So as we develop ourselves and our business and our industry, we get to meet equal sized challenges or opportunities, depending on which way we look at it. So it can't go anywhere but up, if you would consider evolution to be an interesting timeline to apply here.
I fully second that. We're seeing growing demand for these products, ever more index-based as well. So, and I think there's also some evidence that ESG strategies have held up pretty well over the past few months. So for investors that are looking to diversify, invest in line with their principles, and really focus on the long-term impact of what they're investing in, as well as on their financial well-being, then there's no doubt about it. The ESG proposition that is now going to obviously take different shapes and sizes depending on the structure, etc., is here to stay.
What's your as you engage with members, Federico? What's your sense for their take on ESG? Is it a fad, or is it something that they believe in, or is it something that they will deliver because they think clients want it?
It's both. It's both. It's certainly demand-driven. Clients want it, and more and more, asset managers, being fiduciaries, want to offer that product.
What about you, Shannon? Are you an ESG believer, an ESG investor?
I think anything that contributes to what is sustainable and profitable is the way. So yes, I think there has to be a balance struck with all of those periphery interests. It's a long way to say yes, isn't it, Danny?
Well, I think this is an opportunity for the EU to, I guess, to put up or shut up, in terms of how they respond to us as a union supporting each other and each member state to get out the other side of this crisis, and how much we actually drive on and deliver on ESG and non-bank-based financing, which funds and the asset management industry forms a huge part of. So you're going to see a lot of assets ready for deployment, and how they are deployed and where they come from is I think the challenge, and it will be interesting to see if the union can pull together and really prove itself, or whether it goes the other way and becomes very fragmented, and we start to see that it's not all that a lot of people hoped it would be. So there's the big picture thinking, I think.
That is certainly true. If you look at all the discussions around the bailout fund of these days, that is really where Europe needs to come together as a political entity more, and show solidarity. But more specifically in relation to ESG, as an industry, we welcome clarity. The action plan that was unveiled by the Commission in 2018 has morphed into several competing files, which are not necessarily consistent. The big challenge we have is getting sufficient quality information to do those assessments that are required for the portfolio manager to show vis-a-vis the client, here's my product, and this is how it is environmentally or socially or from a governance perspective responsible. We still do not have sufficient data across the many companies that we invest in to certify that we can meet what the politicians and the policymakers here in Brussels would like. So the road there is going to be bumpy when all of this comes into force, but we'll gradually adapt and we'll certainly be able to offer these products more and more going forward. But getting there is not easy, because it really requires changes to some deep-seated thinking, not to mention compliance, and even relationships with our own clients.
It seems to me, Federico, that the ESG world, the ESG regime, is becoming heavier and heavier in the data field. Data is becoming more and more important to how ESG will work and how you certify. And it seems to me like there's ripe pickings there for regtech firms to arrive with solutions to help you pull that data together to certify and disclose and do what you need to do.
Yes, so you were seeing it in a wave of acquisitions. The large managers have started buying up smaller companies that are able to sort through data. They have access to numerous data fields. We also see this in the index providers world, where you have the large MSCIs go out and really buy up these players so that they can then implement their own ESG indices. So if passive is to grow, obviously passive means tracking an index. Whether you're an index fund or an ETF, you're going to have to refer to an ESG. Now, there needs to be a level playing field in terms of ESG requirements that are put on asset managers and those that are put on index providers. And so far, it's up to the managers to do the heavy lifting, but the index providers, from what I see, will probably not come under the same rules, especially in terms of stringency. So this is a discussion that is now taking place, and we for the time being we see it really consolidating the role of index providers, and this is maybe something that regulators can do something about. If we look at how relatively less regulated they are compared to asset managers, and they are really forming a monopoly, also in terms of pricing power and the conditions they are able to impose on asset managers looking to use their indices.
I feel another podcast topic coming on, Federico. Data and index providers.
Keep me in mind.
But I'm conscious that time is kind of against us. Anything on your side, Shannon, before we wrap up?
No, thoroughly enjoyed listening to you two have this conversation. I learned a lot. Federico, thank you for being here.
You're welcome, Shannon. It was a pleasure. Hope to talk soon again.
Yeah, let me echo that as well, Federico. Great to have you on board. Very interesting to get the views, particularly outside of our own perspective here in Ireland, a bit of a broader European view on the challenges, but also what's happening on the regulatory side and how that COVID-19 is impacting the regulatory agenda and some of the market developments, and particularly interesting how the markets and the stresses that have been put on products maybe prove how well the previous regulatory reforms have worked and give ammunition to the likes of yourself, evidence and data going into future discussions about things like, and I do remember it well, Federico, the NBNIG SIFI.
Yeah.
And on that dark note, let's wrap it up. Thank you guys. Thanks very much for contributing. Thank you, podcast listeners, for joining us in this episode of the Aquest Podcast. And we'll certainly catch you next time. Take care. Bye-bye.
You've been listening to the Aquest Podcast. For information about our training and advisory programs or our academy, visit aquest.ie. For more resources on regs, funds, and governance, check out our YouTube channel, Daniel Lawler, RU, RQ.